So you're looking for a trading strategy that actually works, right? Something simple to get your head around, but surprisingly effective. Well, today, we're going to break one down for you that combines two super popular indicators to find some really high probability setups. We'll go over the exact rules, the common traps you absolutely need to avoid, and the pro tips that can make all the difference.
Look, if you've ever stared at a chart and felt like it's just a bunch of chaotic noise, hey, you're not alone. So many strategies out there seem amazing on paper, but then they just completely fall apart in a live market. That's why we're going to build a system with clear, simple rules designed to help you cut through that noise and spot the real opportunities.
And to do this, we've got two main tools in our toolbox. First up, Bollinger Bands. These create a dynamic price channel that gives us a great idea of when prices are relatively high or low. And second, we've got the RSI, which is kind of like our momentum meter. It tells us if a price move has any real strength behind it.
Okay, first things first. Before we even think about the strategy itself, we've got to get our setup right. The settings for these indicators are absolutely crucial for this to work. So let's get our charts calibrated properly.
So what are Bollinger Bands really? The easiest way to think about them is like a river. That line in the middle, that's the average water level, or the moving average. And those two outer bands are like the river banks. When the price flows all the way out and touches one of those banks, it's a sign that it's gotten pretty far from its average and might be ready to flow back toward the middle.
Now for this strategy, the settings are super important. We're going to use the classic setup, a length of 20 and a standard deviation of 2. So why those numbers? Well, that 20-period length is looking back at about a month of trading, which helps smooth out all the daily craziness. And the 2 standard deviations, that's the magic part. It's statistically designed to contain something like 95% of all price action. It really is the sweet spot.
Okay, next up is our secret weapon, the RSI. Think of it like a speedometer for the market. It doesn't just tell you where the price is, it tells you how fast it got there. It's our gauge for whether a big move is running on a full tank of gas or if it's just running on fumes and about to stall out.
And just like with the Bollinger Bands, we're sticking with the standard settings here. A length of 14, and we're watching those key levels of 70 on the high side and 30 on the low side. Basically, if that RSI pops above 70, the market is screaming overbought. It's a warning that the buyers might be getting exhausted. And if it drops below 30, it's a sign that things are oversold and the sellers might be running out of steam.
All right, now this is important. Let's talk about a huge trap that so many traders fall into. It seems logical on the surface, but man, if you don't see it coming, it can be a real account killer.
It's all based on this idea called mean reversion. Think about a rubber band, right? You stretch it and stretch it, what's it going to do? It wants to snap back. While the market often acts just like that. When a price gets stretched way too far from its average, it has a strong tendency to snap back toward the middle. So the first thing everyone thinks is, oh, easy. I'll just sell when the price hits the top band and buy when it hits the bottom. Sounds simple, right? It's also so wrong. This is a classic beginner's mistake that can drain a trading account really fast. And here's exactly why that doesn't work. See, when a stock is in a really powerful trend, the price can just ride that upper band or that lower band for what feels like forever. It'll keep giving you these little false signals. And if you try to jump in and trade every single one of them, you're just going to get run over again and again.
So, the big question is, how do we avoid getting faked out? How do we know when a move is actually running out of steam and is ready to turn around for real? What's the missing piece of the puzzle?
And this is where our RSI comes in to save the day. It acts as our confirmation filter. It's the key that's going to help us separate the genuine, high-probability signals from all that dangerous market noise.
Okay, so here are the exact rules. For a buy trade, a long position, we need 2 things to happen. First, the price has to touch or even dip below that lower Bollinger Band. But that's not enough. Condition 2, the RSI also has to be below 30. For a sell trade, a short, it's the exact opposite. The price touches or pokes above the upper band, and the RSI has to be above 70.
You see, you need both. Both conditions absolutely have to be met. That's the secret sauce right there. We're no longer just trading a simple price touch. We are trading a price touch that is confirmed by genuinely exhausted momentum. That confirmation is what makes all the difference.
But hold on, we're not done yet, because knowing the entry rules is only half the battle. A truly successful trader knows when this strategy shines, and maybe even more importantly, they know when to just sit on their hands and do nothing.
And here's the #1 rule for when to stay away. Avoid sideways, choppy markets. Seriously. This strategy is kryptonite in a market that's just drifting around without a clear direction. That whole snapback idea we're relying on, it becomes completely unreliable when the market's going nowhere. So what does a sideways market look like? Well, there are a few dead giveaways. First, the Bollinger Bands will get really tight, like they're being squeezed. Second, you'll see the price just chopping back and forth around that middle line. And third, the RSI will be stuck in that boring no man's land between 30 and 70. If you see this happening, the best trade is no trade. Just wait.
All right, you ready for a pro tip that can give your trades an incredible edge? We're going to talk about something called divergence. This is what happens when the price is telling you one story, but your momentum indicator, the RSI, is telling you a completely different one.
Let's take a classic example. Bullish divergence. You'll see the price on your chart actually makes a new, lower low. But, and this is the key part, when you look down at your RSI, it's making a higher low. What does that tell you? It's a massive clue that the sellers are losing power. The downward momentum is fading, even though the price just ticked lower.
Honestly, finding divergence is like getting a cheat code. So imagine you get your main signal, right? Price hits the lower band, RSI is below 30, and then you spot bullish divergence on top of it? Oh, that is an absolutely fantastic confirmation. It can dramatically increase the probability that your trade is going to work out.
So there you have it, a simple yet really powerful rules-based trading strategy. But remember, knowing the rules is only half the battle. The real key to success is having the discipline to follow them every single time. Now that you have the rules, the real question is, can you spot the next signal